Bitcoin, the world's most famous cryptocurrency. The one everyone talks about but few truly understand. You've probably heard people say things like, buy Bitcoin now, or sell before it crashes. But if you're new, all of this can feel overwhelming. The charts, the numbers, the hype, it's easy to get lost. What if I told you that you don't need to guess? That there are simple, proven tools that can guide you as a beginner, showing you when to enter or exit the market, and help you avoid costly mistakes? In this video, I'm going to show you 3 Bitcoin indicators that actually work, even if you're starting from scratch. By the end of this video, you'll have a clear understanding of how to use them to make smarter trading decisions and avoid emotional mistakes. The first and most fundamental indicator is the moving average, often abbreviated as MA. This is one of the simplest yet most powerful tools in trading. If you've ever looked at a chart and wondered why Bitcoin's price goes up and down every single day, the moving average can help you see the bigger picture. Moving average is, at its core, the average price of Bitcoin over a specific period of time. It smooths out the price data, removing the day-to-day fluctuations and allowing you to see the overall trend. There are 2 main types of moving averages. The first is the simple moving average, or SMA. This is calculated by adding up the closing prices over a certain number of periods and dividing by the number of periods. The second is the exponential moving average, or EMA, which gives more weight to recent prices, making it more responsive to recent price movements. So why is this important? The moving average shows you the trend direction. Is Bitcoin in an uptrend, downtrend, or moving sideways? For example, if Bitcoin is trading around $30,000 and the 50-day SMA is at $28,000, this tells you that the short-term trend is upward. If the price crosses below the 50-day SMA, it might indicate short-term weakness. Many beginner traders make the mistake of ignoring these signals and end up trading against the trend, which can be costly. A particularly useful strategy for beginners is using the 50-day and 200-day moving averages together. The 50-day moving average represents the short-term trend, while the 200-day moving average shows the long-term trend. When the 50-day crosses above the 200-day, this is known as a golden cross, which is generally considered a bullish signal. Conversely, when the 50-day crosses below the 200-day, it is called a death cross and is often interpreted as a bearish signal. By simply observing these crossovers, beginners can gain valuable insight into market trends without needing to analyze every single price movement. To use moving averages in practice, open any charting platform like TradingView, Binance, or Coinbase. Apply the 50-day and 200-day moving averages to your Bitcoin chart. Observe the trend and look for crossover points. If the short-term MA crosses above the long-term MA, this could be a signal to consider entering a trade in alignment with the trend. Always combine this with other indicators to increase confidence in your trading decisions. Remember, moving averages do not predict the future. They reflect past price movements and help you make more informed guesses about potential market directions. The second indicator you need to know is the Relative Strength Index, or RSI. The RSI is a momentum indicator that measures how overbought or oversold an asset is. Think of it as a mood meter for Bitcoin. When the market is overly enthusiastic, the RSI spikes. When the market is fearful or panicking, the RSI drops. RSI is measured on a scale from 0 to 100. Traditionally, an RSI above 70 is considered overbought, signaling that the price may soon reverse or pull back. An RSI below 30 is considered oversold, indicating that the asset may be ready for a bounce. This is especially valuable for beginners because it provides an objective way to assess market conditions and avoid emotional decisions. For example, imagine Bitcoin has climbed to $40,000, and the RSI shows a reading of 75. Many traders would interpret this as a warning that the asset is overbought and may correct soon. If the price then falls slightly to $38,000, this is a natural market pullback. Understanding RSI allows you to recognize these moments and decide whether to hold, buy more, or take profits. RSI can also be used to spot divergences. Divergence occurs when Bitcoin's price makes a new high, but the RSI does not reach a new high. This can be an early warning signal of a potential trend reversal. For example, during previous bull runs, there were moments when Bitcoin set new price records, but the RSI showed lower highs. Traders who notice this divergence could anticipate a correction before it happened. For beginners, mastering the RSI can significantly improve timing for entries and exits. The third indicator that beginners must understand is the Moving Average Convergence Divergence, or MACD. While the name might sound complicated, the MACD is actually a trend-following momentum indicator that provides clear signals about market direction. MACD consists of 3 main components: the MACD line, which is the difference between the 12-day EMA and the 26-day EMA, the signal line, which is a 9-day EMA of the MACD line, and the histogram, which visually represents the difference between the MACD line and the signal line. Reading the MACD is straightforward. When the MACD line crosses above the signal line, it is a bullish signal and can indicate a potential buy opportunity. When the MACD line crosses below the signal line, it is a bearish signal and may suggest a sell or exit opportunity. The histogram further helps to visualize momentum. Positive bars indicate increasing bullish momentum, while negative bars show increasing bearish momentum. For beginners, MACD is valuable because it gives clear entry and exit signals, especially when combined with other indicators like moving averages and RSI. To illustrate how these three indicators work together, let's go through a practical example. Imagine Bitcoin is trading at $40,000. The 50-day moving average is above the 200-day moving average, indicating a strong uptrend. The RSI dips to 32, signaling that Bitcoin is oversold within that uptrend. At the same time, the MACD line crosses above the signal line, showing increasing bullish momentum. In this scenario, all three indicators align to suggest a potential buying opportunity. A beginner trader using these tools would have more confidence in entering the market at this point, rather than making decisions based solely on emotions or guesswork. Of course, no indicator is perfect, and beginners must be aware of common mistakes. One of the biggest mistakes is relying on a single indicator. Indicators work best when combined, as each provides a different perspective on the market. Another mistake is trading against the trend. If the overall market trend is down, trying to buy during a short-term bounce can be risky. Overtrading is another trap. Not every signal needs a trade. Waiting for strong confirmations reduces risk. Ignoring fundamentals such as news, regulations, or major events can also lead to unexpected losses, even if your indicators look perfect. Finally, neglecting risk management is one of the most dangerous errors. Always set stop losses and only risk an amount you can afford to lose. For beginners, the most important step is to practice. Start with a demo account or a small investment. Observe how the indicators behave over time, track your trades in a journal, and reflect on what worked and what didn't. Stay updated with Bitcoin news and market trends, as these can impact price action regardless of what indicators show. Patience is key. Profitable trading is a skill that develops over time, not something that happens overnight. When used correctly, these three indicators, moving average, RSI, and MACD, provide a powerful toolkit for beginners. Moving averages help you identify the trend and avoid trading against the market. RSI gives you insights into overbought and oversold conditions, allowing for better timing of entries and exits. MACD provides momentum signals, confirming potential reversals and trends. Combined, they offer a comprehensive way to understand Bitcoin's price behavior, reduce emotional trading, and make informed decisions. To recap, the three Bitcoin indicators that actually work for beginners are moving average to spot trends, relative strength index to identify overbought or oversold conditions, and MACD to track momentum shifts. By practicing these tools, observing real market data, and following disciplined risk management, you can trade with greater confidence and avoid many common pitfalls. Remember, these indicators don't guarantee profits, but they give you a structured approach to trading, which is essential for long-term success. If you found this guide helpful, make sure to like this video, subscribe to the channel, and hit the bell to get more beginner-friendly Bitcoin tips. Start applying these indicators today, practice consistently, and you'll soon notice improvements in your trading decisions. Trading is a journey, and with the right tools and mindset, you can navigate the Bitcoin market more effectively and with less stress.